For nearly a century, the entire edifice of the global economy was built on a single unwavering belief. It was a truth taught in every business school and programmed into every trading algorithm on Wall Street. That truth was simple. United States Treasury bonds are the risk-free asset. They were the bedrock, the sanctuary, the one place where capital could go to sleep, knowing with absolute certainty that it would wake up safe in the morning. This perception of safety was not just about the economic strength of America. It was about the sanctity of the legal system. It was based on an unwritten social contract that said, politics may divide us, wars may be fought, but the banking system remains neutral. For decades, even rivals of the United States parked their national savings in New York. They did this because the US dollar was viewed as the Switzerland of finance, a neutral ground where property rights superseded geopolitical fights. But on a freezing weekend in February 2020, that era came to a sudden, violent end. On February 26, in response to the escalating conflict in Ukraine, the Western powers decided to cross a line that many financial historians thought would never be crossed. In a coordinated strike, the United States and the European Union announced the freezing of the Central Bank of Russia's foreign exchange reserves. We need to pause here to truly understand the gravity of this moment. We are not talking about seizing the superyacht of a corrupt oligarch or freezing the private checking account of a criminal. We are talking about $300 billion of sovereign national reserves. This was the accumulated wealth of a nuclear superpower, money earned from decades of selling energy, money that was legally deposited in Western central banks for safekeeping. In the blink of an eye, with the stroke of a pen, it simply evaporated. Washington described this as a necessary sanction to stop a war. But to the rest of the world, to the central bankers sitting in Beijing, Riyadh, New Delhi, and Brasilia, it looked like something else entirely. It looked like a breach of trust. It was a moment of terrifying clarity. The message that rippled through the global South was undeniable. The United States had effectively sent a silent ultimatum to every holder of its debt. The dollar is no longer a neutral store of value. It is now a tool of foreign policy. Your national savings are safe, but only as long as you remain a political ally. By turning the reserve currency into a geopolitical weapon to solve a short-term problem, the West may have created a catastrophic long-term crisis. They proved that the risk-free asset actually carries the ultimate risk, the risk of political confiscation. On that day, the psychological anchor of the global financial system was lifted. And as we are about to see, once you tell the world that their money is not safe, they don't just stand there. They start to run. While the panic over the Russian sanctions dominated the news cycle in the West, a far more dangerous silence had fallen over the Forbidden City in Beijing. The Chinese leadership wasn't just watching the financial war unfold. They were looking into a mirror. For years, economists had assured them that the interdependence of the global economy was a shield, that the United States would never dare to touch Chinese assets because the economic fallout would be too severe. But the events of February 22 shattered that assumption. Beijing looked at the frozen Russian accounts and saw a terrifying premonition of their own future. They knew that the tensions over Taiwan and the South China Sea were not going away. They realized that if a kinetic conflict were to break out in the Pacific, their own national wallet, the massive stockpile of over $1.3 trillion invested in American debt, would not be treated as sovereign property. It would be treated as a hostage. The vast mountain of US Treasury bonds that China had accumulated over 30 years of trade surpluses was no longer a source of leverage. It had become their greatest strategic vulnerability. They were effectively funding a rival that now held the power to delete their wealth with a single keystroke. The reaction was swift, silent, and brutal. We don't have to guess what they did next. The data tells the story. If you look at the charts from the US Treasury Department, you will see a historic pivot point. In April 2022, just 8 weeks after the sanctions on Russia were announced, the floor gave way. China began a systematic liquidation of U.S. government debt. The selling pressure was relentless. For the first time in 12 years, China's holdings crashed through the psychological floor of $1 trillion. Financial analysts in New York tried to sanitize this event. They went on television and called it portfolio rebalancing. They claimed China was simply needing cash to prop up its domestic property market. But those explanations ignore the timing. You do not dump your most liquid assets at a loss immediately after your neighbor gets their bank account frozen unless you are afraid you are next. This was not a market trade. This was a strategic evacuation. China had initiated a policy of de-risking. They were actively choosing to decouple their financial destiny from the Western banking system. They understood that in this new era of weaponized finance, holding U.S. debt was akin to holding a grenade with the pin pulled out. This move marked the second structural fracture in the global system. If part one was the death of neutrality, part two was the death of the buyer of last resort. The single largest foreign creditor to the United States had decided to leave the table. But this raises a critical question. If the second largest economy in the world is dumping hundreds of billions of dollars worth of paper assets, where are they putting that money? They can't just keep it in cash, because cash can be inflated away. They needed an asset that no government could freeze, no algorithm could delete, and no sanction could touch. They needed to go back to the only money that has survived every empire in history. The shockwaves that started in Moscow and reverberated through Beijing did not stop there. They spread like a contagion across the entire global south, to Brazil, India, Saudi Arabia, and Turkey. These nations, often called the swing states of the global economy, simultaneously realized they were exposed to the exact same vulnerability. They realized that in a world where bank accounts can be weaponized, the only true safety lies in assets that have no counterparty risk, assets that do not rely on a promise from another government. And so, the capital that fled the US Treasury market didn't just vanish into thin air, it rotated. It moved from the digital ledger of Western debt into the tangible reality of physical gold. What we are witnessing is not a standard investment cycle. It is a historic run on the bank. But instead of individuals lining up at a local branch to withdraw cash, we are seeing sovereign nations lining up to exchange their paper dollars for metal bars. The statistics confirm this exodus. According to the World Gold Council, the years following the 2022 sanctions saw central bank gold buying smash through every record set in modern history. We have to go back 55 years to the collapse of the London gold pool in 1967 to see a buying frenzy of this magnitude. But there is a critical nuance here that most headlines miss. It is not just that they are buying gold, it is how they are buying it. For decades, when a country bought gold, they would often leave it in the vaults of the Bank of England or the Federal Reserve Bank of New York for safekeeping. It was convenient, cheaper, and easier to trade. But post-2022, that convenience became a liability. A new trend has emerged, known in the industry as repatriation. Countries are no longer content with holding a paper receipt that says they own gold in a vault in London. They want the metal. They are chartering planes, securing heavy transport, and physically flying their gold reserves back to their own borders. The psychology here is unmistakable. It is a total collapse of trust in the custodian. The leaders of the global south are effectively saying, "We do not trust you to honor your debts, and we certainly do not trust you to hold our savings." This is the definitive end of the trust-based financial system. We are entering the era of trustless finance, where possession is the only law that matters. So, let's recap the board as it stands. You have Russia forced out of the system. You have China voluntarily liquidating its position. And now, you have the rest of the developing world dumping paper dollars to hoard physical commodities. This creates a terrifying mathematical imbalance. The world's biggest buyers of U.S. debt have all left the building at the exact same time. But the United States government is still spending, still borrowing and still issuing debt as if nothing has changed. This leads us to the inevitable catastrophe we are seeing today. When the sellers are everywhere and the buyers are gone, who is left to hold the bag? We have now arrived at the present day, standing in the middle of an economic mystery that is baffling the average investor. If you look at the headlines, the Federal Reserve has signaled victory. They have cut interest rates. Inflation is supposedly under control. By every textbook definition, borrowing costs should be coming down, and the bond market should be calm. But look at the screen. The reality is the exact opposite. Long-term Treasury yields, the number that dictates your mortgage rate and the cost of capital for the entire planet, have remained stubbornly, dangerously high. The volatility in the US bond market, which is supposed to be the most boring stable market on earth, is now moving with the violence of a penny stock. Why is this happening? Why is the market ignoring the Fed? To understand this, we have to look beyond the headlines and look at the plumbing of the financial system. We are witnessing a catastrophic collision between supply and demand. Let's start with the demand side. For the last 40 years, the United States government enjoyed a privilege that no other empire in history has ever possessed. They could spend unlimited amounts of money because there were always three massive whales ready to soak up the debt. These three entities bought US Treasuries regardless of the price, not for profit, but for policy. Those three whales were Russia, China, and Japan. As we have already established, whale number 1, Russia, was harpooned and dragged out of the ocean in 2022. They are gone. Whale number 2, China, realized the water was toxic. They have been quietly swimming away, reducing their exposure by hundreds of billions of dollars in a strategic exit. That left the United States with only one faithful ally, the last buyer of last resort, Japan. Japan is the single largest foreign holder of US debt. For decades, Tokyo has been the reliable piggy bank for Washington. But in the last 2 years, tragedy struck the Japanese economy. The yen collapsed to historic lows, decimated by the widening gap in global interest rates. The currency that powers the world's third-largest economy began to look like an emerging market coin. Japan faced a nightmare scenario. To save their dying currency, they had to intervene in the foreign exchange markets. They had to buy yen. But to buy yen, they had to sell dollars. And where were those dollars stored? They were locked up in US Treasury bonds. This is the final devastating piece of the puzzle. Japan isn't selling US debt because they hate America or because they are joining a geopolitical alliance against the West. They are selling because they are drowning. They are selling to survive. So, look at the scorecard of the big three today. Russia is sanctioned. China is de-risking. And Japan is liquidating to defend its currency. The price-insensitive buyers, the ones who didn't care about the yield, have vanished. In a normal market, when demand collapses, you would expect the seller to cut back on supply. You would expect the US government to say, okay, nobody wants to buy our debt, so we should stop spending so much. But the United States did the exact opposite. At the precise moment the buyers left the building, the US Treasury turned the printing presses to maximum speed. The fiscal situation in Washington has entered a phase that economists call fiscal dominance. The US government is now running multi-trillion-dollar deficits every single year, regardless of whether the economy is in a recession or a boom. They are spending money on war, on social programs, and increasingly on the interest payments for the debt they already owe. This creates a terrifying feedback loop. The government has to issue mountains of new bonds just to pay off the old bonds. We are seeing treasury auctions, the events where the government sells this debt, flooded with supply. This is the perfect storm. You have a supply shock, a tsunami of new debt hitting the market, crashing headfirst into a demand vacuum. When you have too much product and no customers, the price must crash. In the bond market, when the price crashes, the yield spikes. This is the mechanical reason why interest rates cannot stay down. even if the Fed wants them to. The market is bigger than the Fed. The market is demanding a risk premium. The investors who are left, the hedge funds, the private equity firms, the remaining institutional buyers, are not whales, they are sharks. They don't buy for political favors, they buy for profit. They look at the US balance sheet, they look at the weaponization of the dollar, and they look at the missing foreign buyers, and they say, "I will only lend you money if you pay me a much higher interest rate." This is the invisible hand of the market delivering a vote of no confidence. The risk-free asset has become a source of risk. The volatility we are seeing today is the market trying to find a new equilibrium in a world where the United States can no longer treat the global financial system as its own private credit card. Credit limit has been reached, the co-signers have walked away, and the bill is finally coming due. So, we have seen the political trigger, we have seen the strategic exit, and now we see the broken market mechanism. The only question remaining is, what does this mean for you? In a world where the foundation is cracking, where do you stand to protect what is yours? We have reached the end of the story, and the conclusion is stark. The events that began with a single signature in February 22 have permanently reshaped the map of global finance. We are no longer living in a unified, globalized economy. We are witnessing the descent of a new financial Iron Curtain. On one side, we have the G7 and the Western Bloc. Their system is built on debt, financial engineering, and the promise of fiat currency. On the other side, we have the BRICS alliance and the Global South. Their system is increasingly pivoting toward real resources, energy, commodities, and the timeless neutrality of gold. But I want to be very clear about one thing. We must avoid the trap of hyperbole. The United States dollar is not going to vanish tomorrow. It is not going to go to zero next Tuesday. It is too deeply embedded in the plumbing of global trade. It will remain the king of payments for the foreseeable future. If you want to buy oil or an iPhone, you will likely still use dollars. However, the dollar has lost its most sacred title. It is no longer the store of value. It has transitioned from being an asset you hold to an asset you use. It is a hot potato, useful for transactions, but dangerous for preservation. The era where you could simply park your wealth in paper currency and expect it to hold its purchasing power against inflation and geopolitical risk is over. So, what is the lesson for the individual investor? Stop listening to what the central bankers say on television. Watch what they do with their own balance sheets. The people who control the printing presses, the ultimate insiders of the financial system, are selling government bonds and buying gold at the fastest pace in 55 years. They are voting with their wallets. They are telling you without saying a word that they do not trust the paper they are printing. If the central banks are diversifying out of the dollar to protect their national survival, why are you betting your financial future on it? The window to act is still open. The transition from a unipolar debt-based world to a multipolar hard asset world is messy, volatile, and frightening. But for those who see the writing on the wall, it is also the greatest opportunity of our lifetime. Don't wait for the crisis to knock on your front door. Look at the empty chair where Russia used to sit. Look at the exit strategy of China. Look at the desperation of Japan. Become your own central bank. To verify into the real world, because in a future where trust is weaponized, the only thing you truly own is what you can hold in your hand. Subscribe now to stay ahead of the times, because when history is written, you'll want to be among the few who recognized what was coming early. Thank you for watching and being part of the journey.